How do lending and borrowing work in DeFi? In this video, we explain how you can lend and borrow money in a totally decentralized and anonymous way, using the DeFi ecosystem. Lending and borrowing is one of the most common practices of the financial system. The lender generally receives a return, and the borrower instead pays interest on the total amount of money borrowed. Today, the usual way to participate in this activity is through banks. Each bank evaluates its clients and assigns them risk scores to rate their credit worthiness. Basically, what it means is that there are statistically based algorithms to minimize the risk of not returning these loans. In most cases, a guarantee must be deposited higher than the value of the loan we want to access, especially in situations where the loan is high, so that in the event of not paying it, the bank keeps said asset. This makes accessing bank loans a complicated, slow, and inefficient process. The question is, how can we make this process faster, more accessible, and efficient? One of the most promising solutions is using the DeFi ecosystem. Using smart contracts and blockchains, we obtain loans in a fast, efficient, and decentralized way. DeFi not only makes the process of lending and borrowing easier, but it also tends to pay higher interest rates than traditional banking. Decentralized platforms such as Aave or Compound offer this service, and they work in a very similar way, with small variations between them. We're going to explain in this case how the Compound platform works in a summarized way and through an example. Imagine the case that Bob wanted to obtain returns by lending 10 ethers. Once the correct smart contract was located, Bob would deposit 10 ethers in it, and in return he would receive C ethers. The number of C ethers received depends on the exchange rate between Ether and C ether. This exchange rate increases with each block mined, but it does so irregularly, depending mainly on the supply and demand that exists to access these loans. The increase in this exchange rate is what determines the interest generated by the deposit tokens. Suppose Bob has deposited those 10 ethers at an exchange rate corresponding to 0.02, containing 500 C ethers. After 1 month, the exchange rate rises 5%, from 0.02 to 0.021. If Bob deposited his C ether back in the smart contract, he would receive 500 multiplied by 0.021, that is 10.5 ethers, thus obtaining a 5% return. Now imagine the case where Alice wants to borrow 2 ethers. To reduce the risk of not paying it, she has deposited collateral, that is, another token. The value of the collateral has to be greater than the value of the tokens borrowed to fully mitigate the risk of the lender, and that the volatility of the market does not force the liquidation of the positions. Why would Alice want to access a loan for which she must deposit collateral with a value greater than that obtained in the loan? It turns out that many times users do not want to sell certain tokens, for example, to defer paying taxes on the profits obtained from the sale. The exchange rate in this case also determines the interest Alice has to pay for the ethers obtained as a loan. Once the loan is repaid with interest, the initially deposited collateral is released. Using this type of platform has its risks. Among them is paying high interest rates, or the risk that the collateral deposited will be liquidated due to market volatility. The lending and borrowing system at DeFi is still young, but it has a lot of potential for improvement. In the following video, we'll explain how you can obtain loans without having to deposit any collateral. At Yielding, you can participate in a wide range of DeFi opportunities through smart contracts and start generating passive income like never before, easy and transparent. We encourage you to be part of this new revolution. Follow us and like us to learn more about DeFi. You can also visit the link in the video description to register on our platform and start generating passive income in the DeFi ecosystem.